Hi, my name is Christopher Lester, and I'm a chartered financial consultant, which is like a CPA in financial planning. I'm also a retirement income certified planner, as well as a certified college planner here in Somerset, New Jersey. And in almost 30 years in business, I've seen a lot of folks walk through our doors. And when I look at their portfolios or analyze their investments, I'm seeing that not a lot of attention is being given to some of the factors that we should or take into consideration when making investment choices. Today's video is a continuation of a video I've done recently on sequence of return risk. And if you remember, there was a section in those slides where there was a nomenclature called Sharpe Ratio. Today's video, we're going to do a deeper dive into Sharpe Ratio, what it is, and what it means to you in your portfolio. See you on the presentation. Hi, Chris Lester here, continuing our conversation on Sharpe Ratio. Now, William Sharpe is the founder and creator of Sharpe Ratio, and he was actually a professor at Stanford's University's Graduate School of Business and actually a Nobel Prize winner. And he created Sharpe Ratio for risk adjustment investment portfolio analysis. So what is the formula? Well, the Sharpe Ratio equals the expected return of a portfolio minus the risk-free rate of return divided by standard deviation of a portfolio's return. Boy, that's a mouthful. So let's break this down a little bit. The expected rate of return, or the average return, minus the risk-free rate. What is a risk-free rate? Well, that's what typically treasury bills or bonds are paying. And I actually looked this morning, treasury bills a year ago were paying just under 2%. And today they're paying 10 or 11 basis points. That's just shockingly low. And then standard deviation, right, is the variability of a portfolio. And we went over another video on that. So if you want to look up standard deviation, I have a video on that. So you take that average rate of return minus the risk-free rate of return divided by standard deviation, and that will give you the Sharpe Ratio. So how important is the rate of return? And then when I talked about these slides on our video on sequence of return, Sharpe Ratio was blacked out here. And I said I would come back to it in a different video. Well, this is that video. And as you can see, the first portfolio 1, had a Sharpe Ratio of 0.23 versus portfolio 2, which is being managed by ABC investors, had a Sharpe Ratio of 0.49. So what are these numbers or factors telling us? Well, again, the Sharpe Ratio, average rate of return. So if we go back to our, say this one here, 6.40, right, minus the risk-free rate of return, which I said was last year was 2%. So, 6 minus 2 would have given us 4, right, if that's the period of time we were in, divided by the standard deviation of this portfolio. So again, what is that? That's where the factor comes in that you're looking at, and that's where you'll either get a 1, lower than a 1, above a 1, but that's what it's telling us. But what's it mean in simple English? It really just means, are we being rewarded for the amount of risk that you're taking? So let's put a picture to that question. I showed in a previous video a Morningstar report, and Morningstar is an independent third-party analytical firm that's just showing, just information and data. And in the lower right-hand corner of this client's portfolio, when we did an analysis, we measured their performance against a benchmark. So if you look on the lower right-hand side, you'll see a blue line that goes from left to right that is, light blue, that's slowly rising from left to right over time, and that's over a 10-year period. But then you see above that or near that a maroon line that is going up and down, comes back, touches the benchmark, and then later on to the right, it spikes up, chops up and down, and then it falls off a cliff. And so this is fine. This is volatility. If you're going to take a large amount of risk, typically you expect your portfolios to be volatile. But the question you want to start to ask yourself is, as we're heading into retirement, can we afford or do we want to take this amount of risk? But more directed towards this question, let's look at the Sharpe ratio of this portfolio. And as you can see here, I pulled the Sharpe ratio, and there's a 3-year, 5-year, and 10-year average. So the portfolio, the first set of numbers to the left, in 3 years, are we being rewarded for the amount of risk that we're taking? And as this number is closer to 1, the answer to this would be yes. But then over 5 years, right, the benchmark starts to catch up a little bit, still not quite. I would still say that the portfolio, yes, we're being rewarded for the amount of risk that we're taking. But if you look at the portfolio as 10 years compared to a benchmark, now you have to ask yourself, I don't know if the amount of risk is worth it, especially as we approach retirement. But this is just a factor. It's just one of the things that we look at in a combination of factors to evaluate a client's portfolio. And what we quite often see is that most people that are invested in their 401ks, their IRAs, if they're doing it themselves and have no professional advice, that quite often they have no attention to some of these very critical components, and they find out way too late that there were other strategies that they could have implemented. So again, what is a good Sharpe ratio? That indicates a high degree of expected return for a relatively low amount of risk, right? I mean, don't we want to get more for less risk? So usually any Sharpe ratio greater than 1 is considered acceptable by good investors. But a ratio of about 2 or 3 is considered very good or excellent. So, key takeaways, the Sharpe ratio indicates how well an equity investment performs in comparison to the rate of return of a risk-free investment, such as government bonds or bills. To calculate the Sharpe ratio, you first calculate the expected rate of return or the average return on an investment portfolio or individual stocks, and then subtract the risk-free rate of return. And then you divide that by the standard deviation. But the main problem with Sharpe ratio is that it's accentuated by investments that don't normally have distribution of return. So it shouldn't be something that we put all of our weight on. It's just a factor. Folks, I want to thank you for joining us here today. Hope you're finding these videos insightful and easy to understand plain English. Chris Lester, Chartered Financial Consultant, Retirement Income Certified Planner, as well as a Certified College Planner here in Somerset, New Jersey, wishing you to have a great day. And if you have any questions, please give us a call. Bye-bye.